Well, as we noted, CPI came in even hotter than expected in December, and we can see the major averages reacting mixed on this news. Joining me now is John McClain, Brandywine Global Portfolio Manager. Good to see you, John. So give us some context here, because you're saying that this doesn't really move the needle in terms of the market narrative. Why is that?
Well, the market wants to go higher, and I think we got a slightly stronger CPI today, and we're seeing a bit of a pullback, but not anything meaningful right now. And I think the three biggest things to take away from the CPI report: one being the shelter component up 0.5%, and that's in line with recent trend. But we think housing is going to be strong in 2024, and because it's the biggest component of CPI, that's going to be a real challenge to see us moving from kind of this mid threes, high threes type of number down to the Fed's target of 2%. And then other components that have been pretty volatile, things like airfare and used cars, were only up 1.5%. So they're not as volatile anymore. So we're not going to see as much noise, I think. And then the last piece really is the medical care component, being up 0.6% for the second month. I think that's going to lead to the potential for some higher prints in 2024. So the market narrative has gotten ahead of itself. It's saying 6 cuts. It's saying balance sheet runoff is going to slow down here. We think that if that were to be correct, then the soft landing's out off the table here. You're not going to see 6 cuts plus a slowdown of QT with the economy doing fine.
And so then as we look at some of the messaging here, I know markets looking for some clarity on the Fed kind of hedging their bets so that markets aren't really short, which is why they're running with sort of whatever narrative makes sense for them. But you compare the Fed and the market relationship to an old married couple. How does this relationship end up going from this point, given this data?
Well, again, the Fed's message is constantly muddled here. We had Logan saying balance sheet runoff's going to slow down. We had Williams contradict that. And the market just says, hey, risk on, and let's keep going and pushing stocks higher and bond yields lower. I think at a certain point in time, the data is going to support more of where the Fed is saying rates are going to be by the end of 2024, which is a couple of rate hikes, and it's not happening in March. And the market's gotten, again, way ahead of itself here. And I think we'll continue to get more data, and the market will coalesce to where the Fed is this time around.
And so then when you look at some of the fundamentals in the market, obviously we saw the narrow rally with the tech stocks, and then we saw that start to broaden out. But what are you looking at in terms of valuations at the moment?
Well, yeah, fundamentals are really strong, and we've got a number of conferences going on right now: the JP Morgan Healthcare Conference, the ICR Conference, CES, and kind of the information that we're getting out from companies here is that things are pretty reasonably strong in the marketplace, and we think we will see some nice top line growth and potential margin expansion from companies in 2024. The problem with this is that valuations are very high. You look at the S&P 500 trading at 22 times PE. That's an elevated level, particularly with Fed funds north of 5%. You look at investment grade credit spreads trading around 100. That's a pretty tight level. And same thing with high yield at about 350 spread. We're kind of priced for the soft landing, for the Goldilocks narrative, and it's going to be hard. And we think, as we mentioned a little bit earlier, there's going to be some conflicting data, which leads to the potential for CPI to stay elevated in 2024. I don't think we're going to be declaring victory before we have the presidential election.
So, John, then for those who are looking more long-term, what are some of the risks or the opportunities that you're looking ahead at, as opposed to sort of this jumping from month-to-month data as we tend to see markets do?
No, absolutely. I wish we could focus more on the longer term in these types of discussions. And really, there's 3 key themes that I think are going to permeate for the next several years. And one is deglobalization, one is decarbonization, and the other one is population demographics. As we're aging in the developed economy, all these things are inflationary in nature. And so I think inflation is going to be a discussion that we're going to continue to have for the foreseeable future, the next several years.
And of course, we're looking ahead to the elections in November. It feels like the election cycle just never ends, but particularly for markets, what sort of risk are they pricing in at the moment? Or is it really on the back burner as they're really hyper-focused on things like inflation and waiting to see sort of AI adoption and improvements there?
Yeah, absolutely. I mean, I think we'll start to turn our attention to the election next week with Iowa. But I don't think that we're really going to be paying close attention until sometime in 2Q. And election risk isn't priced into the market. One way or another, the Fed's going to be politicized for how they act. We think that's wrong, but the timing and size of cuts will impact who gets elected. We would also say that you want to buy risk into an election day, irrespective of the outcome. The market hates uncertainty, and as soon as that uncertainty is removed, despite the outcome, the market's going to move higher. We think that also going into this election year, you're going to see the Democrats looking to spend and stimulate however they can. Again, that higher spending and higher fiscal deficit is most likely going to be inflationary, and thus we believe that leads to that higher for longer outcome.